Hello, my name is Christopher Peters, and today we are going to be reviewing and analysing the Commonwealth Bank's financial statements. We're going to apply some key accounting and financial concepts to develop a firm understanding of the bank's current financial position. As most Australians would be aware, the Commonwealth Bank of Australia is a common household name and is the financial institution for 1 in 3 Australians. It claims to have 17.4 million customers and the largest branch network in Australia. The CBA was founded under the Commonwealth Banking Act of 1911 and began operations in 1912. The bank now has over 48,000 employees operating primarily in Australia and New Zealand. The CBA's stated purpose is to improve the financial well-being of our customers and communities, and these, they claim, are underpinned by the stated values of: we do what is right, we are accountable, we are dedicated to service, we pursue excellence, and we get things done. It is, however, important to note that these values and purpose first appeared in the 2017 annual report. This is a considerable shift from the previous reports and now is responding to the social demands of their investors. The CBA has a plethora of information in their annual reports. Today we're going to be looking at the assets, liabilities, income, expenses, and equity classes. This can be found in the annual report and aids decision making and provides us key indicators for potential investors. This information can be found within the balance sheet, income statement, and statement of changes in equity. All figures throughout this presentation is displayed in millions to allow us to effectively compare their reporting position. We will begin by analysing the bank's assets and liabilities. As a large organisation, the CBA groups operations to their various products, with the majority of assets and liabilities belonging to the banking group. Displayed is the assets section of the CBA's 2019 balance sheet. As you will quickly notice, the largest asset is loans, bills, discounted, and other receivables to the value of $755,141 million. In layman's terms, this is how much is owed to the bank through home loans, personal loans, and business loans. Other key assets displayed on the balance sheet is the cash and liquid assets to the value of $29,387 million, and also the bank's investment securities, consisting of amortized cost and fair values of other comprehensive income, both combined $86,267 million. This brings the total group assets to $976,502 million. 99% of all assets belong to the banking group. Looking at the bank's liabilities, deposits and other public borrowings is the largest liability the bank holds, worth $636,040 million. And also the bank's insurance policy liabilities, worth $163,990 million. The total liabilities held by the CBA is worth $906,853 million, which brings the CBA's net assets to $69,640 million. Grouping assets and liabilities into relevant subgroups allows us to quickly analyse how we went compared to 2018 to 2019. As displayed, we can see that total group lending accounts for 75% of all assets held by the Commonwealth Bank. This consists of home loans, consumer finance, and business and corporate loans. The same can also be done with liabilities, which consist of deposits, debts issued, and other liabilities. As you can see, the figure of the total assets of $976,502 million matches that of the assets on the balance sheet previously, and the total liabilities of $906,853 million also matches. Comparing to 2018 and 2019, we can see the assets and liabilities both were held steady. However, another change percentage is where we want to have a look at. The home loans have actually increased by 4%, but we lost by 6% and 3% respectively in consumer finance and business corporate loans. However, due to the figures, total group lending was up by 2%. Looking at the liabilities, we can see that there's been more deposits put into the bank, up by 2%, but we've also decreased by 5% and 6% respectively from debt issued and other liabilities. This is just a snapshot to give us a financial position of how many assets and liabilities are held by the CBA. Moving to the income statement will give us a snapshot of the income and expenses incurred by the CBA over the 2019 reporting period. As was done with assets and liabilities, the CBA provides a column for the bank and another for their group activities. We can also group the income and expenses to develop a picture of operating income and operating expenses. While the annual report provides a lot of data, it also provides a lot of explanations, with the Commonwealth Bank explaining why things have happened. As we can quickly see from this snapshot, the total operating income has fallen by 2%. The net interest income, other banking income, and funds management income has all fallen by 4%, where the insurance income has fallen by 38%. As I said, The CBA offers some explanation, but most of this is attributed to the Royal Commission into the misconduct in the banking, superannuation and financial services industry, which led to sweeping changes of practice in the CBA insurance group. Across on operating expenses, we can see that they've risen by a total of 2%, with staffing costs and information technology both rising, but occupancy and equipment and other expenses falling, leading to a total, as I said, to 2% increase. Being listed on the Australian Stock Exchange as a company allows for multiple shareholders to have ownership of the bank's equity. As displayed at the bottom of the balance sheet, the total shareholder equity is $69,649 million, which is made up of the ordinary share capital, reserves, and retained profits. Equity represents how much would be distributed if all assets were liquefied at book value and liabilities settled, leaving the total equity to be distributed evenly across the 1.77 billion shares in circulation. Shareholder equity increased by 2.5% from 2018 reporting period, and a further breakdown of changes in shareholder equity is present on page 115 of the annual report. On page 119, the accounting conventions and policies of the Commonwealth Bank are introduced, with the Commonwealth Bank utilising the interpretations of the Australian Accounting Standards Board and also meeting the International Financial Reporting Standards. They do this in order to adhere to the Australian Government and other regulators, with a managerial judgment to how they are going to be displaying their data. Within their annual report, they have all figures in Australian dollars with foreign currency converted at a set rate, and they're rounded to the nearest $1 million. There is a plethora of information in the note section. However, two key assets which are affected by this is the cash and liquid assets in note 5.1 and loans, bills and other receivables in note 3.1. These asset classes are measured as what's called fair value, which in accounting terms references the estimated worth of the asset group, and then measured at amortized cost. The term amortized cost is the cost of keeping the asset. With lending money and charging interest being the primary income for CBA, the cost of keeping the loan as the administration and customer services expenses to retain the customer's loan in order to keep collecting the interest. As with most assets, the expected life of the asset will generally decrease over time, generally with the loan being paid off at set periods with a set end date. Now we have a basic understanding of CBA gained through reading the 2019 annual report. We can use this financial information to understand CBA's profitability, liquidity, and efficiency. The standard accounting technique to review and benchmark a firm's position and performance is to use relevant accounting ratios. We will be using these accounting ratios to compare the performance of the Big Four, referring to the other four major banks in Australia: the CBA, Westpac, NAB, and ANZ. First, we're going to be looking at profitability of the Commonwealth Bank, looking at the net profit margin, which is calculated by net profit divided by the firm's revenue. The return on equity ratio is the net income divided by the average shareholder equity. As displayed, the CBA's net profit margin is 35.54%. This is far superior to the other competitors, with the industry standard sitting at 20.17% and the whole global sector sitting at 14.71%. The return on equity is 14.57%, far outpaces the rest of the competitors. The profitability ratio suggests the CBA is highly profitable, especially when benchmarked to their primary competitors. Looking at the last 5 years, the CBA is holding around 38% of net profit margin. However, the return on equity has fallen by 5% since 2015. However, this trend is also observed by Westpac, ANZ and NAB, with all of the Big Four banks contracting by at least 5% in their return on equity ratio. In terms of liquidity, financial institutions are often difficult to judge if one only uses the current ratio. The current ratio is calculated by current assets divided by current liabilities. The bank's current assets is primarily its cash on hand, and its current liabilities is the deposits owed to the customers. If there was a run on the bank, similar to what we saw in Mary Poppins or in 1910 Bank of England, this ratio would be blown out of proportion as the bank would not be able to meet its obligations. So therefore, it's an inappropriate ratio to consider for financial institutions. A better ratio to use would be a gearing ratio, which is our debt to equity. The debt to equity measures the degree which a company is financing its operations through debt versus wholly owned funds. More specifically, it reflects the ability for shareholders' equity to cover all outstanding debts in the event of a business downturn. This is judged by debt plus other fixed payments divided by shareholder equity. As displayed, the CBA has a ratio of 2.96, which is lower than NAB and Westpac, but still higher than ANZ. As a whole, the Big Four banks are using a significant portion of debt being the customer's deposits, to finance their operations. Historic data suggests the last 4 years have held steady, with the CBA following the trends of the other Big Four banks. The term efficiency refers to the firm's ability to how well they use their assets and resources. The two that we'll be looking at is the revenue and employee and the asset and turnover. The revenue per employee is measured by the total revenue divided by the total employees. And asset turnover is the total sales, being the lot of assets, divided by the beginning assets and ending assets divided by 2, giving you the asset turnover. As displayed, the Commonwealth Bank produces $519,517 per employee. This outperforms ANZ and NAB but falls $100,000 short of Westpac. The second ratio that we're looking at is asset turnover, with all banks sitting on 0.02. This represents the bank makes 2 cents per every $1 of assets held. Looking at the last 5 years, the CBA had a downturn in 2019 reporting period, falling from 0.03 to 0.02. While the revenue per employee ratio fluctuates, it is displaying a downward trend starting when the Royal Commission was conducted. With all this data, we can use a SWOT analysis to decide if the CBA is a good investment. Looking at the financials, we can determine that CBA has a strong capital and asset base and a sound liquidity position for a financial institution. However, a weakness of the bank is its productivity ratio, which was present in the falling efficiency. There are, however, several opportunities, such as the business restructuring due to the Royal Commission and current digital initiatives. Several ongoing threats to the bank will need to be monitored, as the rising risk of online identity theft and hacking, and also the global environment being volatile, uncertain, complex, and ambiguous, which has led to a low interest rate environment. Today we have reviewed and analysed the Commonwealth Bank's information from the 2019 annual report. We've also benchmarked and compared these to the other of the Big Four Australian banks. Despite recent major events such as the Royal Commission, historically low interest rates, and a global pandemic, the Commonwealth Bank has a history of being financially successful and moving to meet the financial needs and demands of the Australians and their customers. Therefore, the recommendation from today's presentation would be to buy and hold for a stable long-term investment. These are based off the consistent strong dividends, strong profitability ratio, and also a strong asset base. My name is Christopher Peters. Thank you for joining me, and I'll see you next time.